Hello, my name is Justin Gregory. I'm a student at Southeastern Louisiana University, and today we're going to talk about an investment strategy project. Basically what we're supposed to do is choose an investment strategy that we wanted to do, and then prove that if it works or not. So I chose a variation of the Dogs of the Dow. The Dogs of the Dow is a very popular investment strategy. Especially for like beginners and people that really don't look into investments all that much. But anyway, it's a variation of the Dogs of the Dow. So there's a couple variations that I like to talk about, but I'm only going to choose one. The first variation is the Dow 5. It includes the 5 Dogs of the Dow that had the lowest per share price. And then from there, it's Dow 4, which includes the 4 highest priced stocks of the Dow 5. And then what we're going to talk about today is the Foolish 4. So this was made famous by Motley Fool, and it's similar to Dow 4, but it allocates 40% of the portfolio to the lowest priced of these 4 stocks, and 20% to the others 3 stocks. So I thought that was kind of interesting that it was kind of different because it did re-weight them differently. So the Foolish 4, I tracked this from these for these specific companies that I'm about to talk about. I tracked them from January 1st, 2014. I chose the lowest price per share stocks in 2014 and tracked them all the way to 2015. These are all just, random, and I wanted to see if we had a return relative to what the Dow Jones had overall. So I chose the 4 lowest price stocks on the Dow Jones Industrial Average, and at the time in 2014 the lowest stock prices per share were Cisco at $22, Pfizer at $30.46, Intel Corporation at $25.79, and then General Electric at $27.50. So obviously you can see that Cisco is the lowest price, so we're going to invest 40% of whatever our original investment is into Cisco, and then 20% to the others. So what I did is I tracked them from January 1st to 2014 to 2015, and I chose the lowest price stocks, and I got the daily returns for those stocks over the course of a year, and I multiplied them by their weights, which Cisco is the only one that has a 40% weight. The others have 20%. So the average return for each company and the standard deviation, I'll tell you in a second. Cisco had a 0.09% daily return with a 0.0104 standard deviation. General Electric had a negative 0.0293% with a 0.0094 standard deviation. Intel Corporation had a 0.1460% average daily return with a 0.0141 standard deviation, and Pfizer had a 0.0142% daily return with a 0.0103 standard deviation. The portfolio had the entire portfolio, when you consider their weights and everything, had a 0.0658% daily return with a 0.0083 standard deviation. And this is what the Dow Jones Industrial Average had. They had a 0.0345% average daily return and a 0.0068 standard deviation. So the portfolio had a better average daily return overall over the entire Dow Jones in general, and also had a higher standard deviation, but it's not very significant. Dow Jones overall, now this is from beginning to end, had a 8.4039% overall return, not average, overall. And the Foolish 4, which is the strategy I chose, my entire portfolio had a a 16.9363% return. So it was double the amount that Dow Jones Industrial Average, double the return the Dow Jones Industrial Average had, and it had a correlation of 0.7763. So it's very strong. Obviously, I mean, these companies are from the Dow Jones, so it's going to have a strong correlation. So this is the efficient frontier with standard deviation in the mean, and the average daily returns in the y-axis. I mean, standard deviation in the x-axis and daily returns in the y-axis. And these four little dots right here are Cisco, GE, Intel Corporation, and Pfizer. So basically, given their specific standard deviation, what return did they get? And these two dots are Dow Jones and the results for Foolish 4. This is Dow Jones right here. So it's a little bit below the 0.04% average return line and above the 0.006 standard deviation line. And this, so basically when it changes, when it goes from there to Foolish 4, it goes up and to the right, but it goes significantly up, and it goes to the right a bit, but not so significant that you wouldn't even bother. So the little green dots above the 0.06% line, and then above the 0.008 standard deviation line. Anyway, so I figured that because you get a higher return, it doesn't always work. It really kind of depends on the companies that you choose, but the whole thought process on this investment strategy is that these companies will always bounce back up. That the worst performers or the lowest stocks will eventually rise, and they are the cheapest stocks. So it doesn't always work given a certain amount of time. I just chose to do it over the course of a year, this specific year, and to see if it did work, and it happened to work. I wouldn't say it always works, but that is the Foolish 4. Anyway, guys, I appreciate y'all listening to me today. Hope you have a great day. Thank you very much.